Changes in the One Big Beautiful Bill are being called some of the most significant updates to crop insurance and farm safety net programs in history. But beyond bigger subsidies and higher reference prices, Farm CPA Paul Neiffer says the bill could also push some producers to rethink how their farms are structured, from partnerships to LLCs and even S corporations. But what are the biggest changes to crop insurance in the One Big Beautiful Bill? That's exactly what we asked Neiffer during Top Producer Summit this week.
Yeah, so under the One Big Beautiful Bill, we have about 3 major changes to crop insurance on the what we call the revenue protection plans. From the 55% up to the 75% level, we got an extra 5 percentage point increase in the subsidy. So let's say it was 50, now it's 55%. At the 80 and 85% level, it went up by 3 percentage points. So that's helpful, not quite as good as the other ones, but still pretty good. And then for SCO, there's major changes there. There's a supplemental coverage option that now goes up to 90%, just like ARC now goes up to 90%. And then another provision that's very helpful for our beginning farmers. Under the old rules, they got a 10 percentage bump in that premium subsidy, but it was only for 5 years. Now this expanded, the One Big Beautiful Bill expanded to 10 years, 15% subsidy year 1 and 2, 13% in year 3, 11% in year 4, and then 10% year 5 through year 10. So for a lot of those young farmers out there, they really should be maybe a farmer on their own instead of a farmer with their parents, because they're able then to take advantage of that premium subsidy. Whereas sometimes if they do it with their parents, they may or may not get the premium subsidies. So certainly when I'm talking to the farmers, I'm definitely, if they're bringing in junior or juniorette, have them be on their own for the first 10 years now. It's actually, from a family standpoint, they're going to make more money.
Neiffer says those enhanced subsidies, especially for beginning farmers, could mean it makes financial sense for younger producers to operate independently rather than staying under a family entity. But it's the new rules surrounding payment limits that could drive bigger conversations in farm offices across the country, even the need to restructure some farms. And it's all because of the One Big Beautiful Bill.
Oh yeah, there's definitely the ability for many farmers that right now are farmed as a general partnership with all these extra tax returns they have to do. They might be very easy to go switch to an LLC, get that same legal protection that we really like to see from a farm operation, but have multiple payment limits. Because right now under the old rules, an LLC and S corporation only have 1 payment limit. Under the new rules, it's based on the number of equal owners. Now, conversely, a C corporation, there's lots of farms out there farming as a C corporation. They're going to be stuck with 1 payment limit, so they probably are going to be thinking about switching to an S corporation. And I've talked to several farmers already that either have switched or will be switching.
Now, Neiffer cautions that guidance is still needed before producers make structural changes. Well, she didn't grow up planning a life in production agriculture, and her path to the farm was anything but traditional. After the break, we head to Oregon to meet a female farmer whose can-do attitude and fierceness with independence garnered national recognition during Top Producer this week.